Welcome to another edition of Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. This month's topic is portfolio diversification, and this is a term you hear a lot with investing, so I thought it'd be great to spend some time talking about not only why is this so important, but what does it actually mean to have a diversified portfolio? Portfolio diversification at a high level is about managing risk. It's putting your money into different types of investments in different asset classes so that you're spreading out the risk in a way that if market conditions negatively impact one type of investment, it might not have a negative impact on your portfolio as a whole. Think about it in terms of weather. It could be raining in one town, but you drive 10 miles north to the next town and it's 75 degrees and sunny. Diversification is preparing your portfolio for these different kinds of weather that can come your way. Your two most basic types of investments are stocks and bonds. Traditionally, the more risk you are comfortable with, the longer the time horizon, the more money you can allocate towards stocks to try to achieve growth. And vice versa, if you're more of a conservative investor, or if you have a shorter time horizon, or if you need your portfolio to generate more income than growth, then you could allocate more towards bonds. Stocks and bonds have an inverse relationship, or what is referred to as negative correlation. This means that their prices tend to move in opposite directions. So if there are circumstances that are putting downward pressure on stock prices, then bond prices might be rising at the same time, which gives a buffer to your overall portfolio. It doesn't always work out that way, but historically, stocks and bonds have served as somewhat of a hedge against one another. The next step in diversification is making sure that you are spread out into different types of stocks and different types of bonds. This is a term that we call asset allocation. On the stock side of the equation, there are a lot of different types of stocks that you can consider for your portfolio. We have large cap growth stocks, large cap value stocks, mid cap growth stocks, mid cap value stocks. We have small cap stocks, international stocks. The list goes on and on. Figuring out which of these makes sense involves getting into the deeper investment research. And there are a lot of factors that come into play. Economic conditions, interest rates, inflation, investor confidence, government policy, the current tax environment, global events. These all come into play in deciding which asset classes could make sense at any given point in time for your portfolio. Then on the bond side of the equation, there are several different types of bonds to consider for your portfolio. We've got corporate bonds, municipal bonds, international bonds, treasuries, agency bonds, just to name a few. And just like stocks, bonds are impacted by different economic and global factors, which means allocating money to them appropriately is an important part of portfolio diversification. One trap that investors can fall into when choosing asset classes is what we call chasing performance. Yes, analyzing the performance of an investment is very important, but just because a certain investment performed very well over the last 3 years doesn't mean it's going to continue to do so. The reason for that is some of those same factors I mentioned that you have to take into consideration when picking stocks and bonds, they're always changing. So, some investments can perform well under one environment, but if that environment changes, that can lead to poor performance, which is why we can't chase performance. As an example, the low inflation and low interest rate environment that we had from 2019 and 2020, those were favorable conditions for the bond market. But getting into 2022, when inflation started to tick up, when interest rates increased, that was a very challenging environment for bonds, which led them to have one of the worst years for bonds that we've seen in decades. So if you invested a bunch of money into bonds in 2021, just because you saw how good they did in the last couple of years, you got hit pretty hard in 2022 by chasing performance. So to be truly diversified, most investors need to start with an appropriate mix of stocks and bonds. And after that, you need to be spread out amongst these different asset classes that have an opportunistic outlook based on the current environment. Over time, as conditions change, you need to revisit your mix of stocks and bonds, rebalance, and make adjustments as needed to make sure you stay properly diversified. The idea is if it's raining on one spot of your portfolio, it can be 75 degrees and sunny on another spot of your portfolio. The end goal of diversification is to help your money achieve your desired goals while trying to smooth out the ride as best as possible and not subject yourself to too much risk. So there's a lot involved with diversification, which is where I can add value to my clients in helping them navigate all these variables. If you have any questions on the information in this video, or you would like to talk more about your investments and how diversification might be able to help, please don't hesitate to reach out. I appreciate you watching, and I look forward to talking with you soon.